Welcome everyone to Talking Data. I'm Kristen Radosh with Arbor Research and Trading, joined today by our commentator, Jim Bianco of Bianco Research. Welcome, Jim.
Thanks for having me.
Today, Jim will discuss the year-to-date performance of the Bianco Research Fixed Income Total Return Index and the market versus the Fed. Jim, last year you started the Bianco Research Fixed Income Total Return Index. And there's an ETF that tracks the index, the Wisdom Tree Bianco Fund, the symbol WTBN. Tell us about the structure and its performance in the first half of 2024.
So technically, I am not an ETF manager. I am an index manager. I run, as you pointed out, the Bianco Research Fixed Income Total Return Index. If you have a Bloomberg, it's BTRINDX. Or if you don't have a Bloomberg, it has its own website called biancoadvisors.com. That index is a discretionarily managed index. We like to use the term tilts. We start off with a benchmark of a broad base of investment grade securities, and then we intentionally tilt it. Do we want to be overweight or underweight certain, if we want to be overweight or underweight, duration or curve or structure or corporates? Do we want to have an out of index bet like in high yield or the dollar or tips and the like? And we usually have an investment meeting once a month. Back in late December, Wisdom Tree started an ETF, WTBN is its symbol, the Wisdom Tree Bianco Fund. It tracks our index. If you want an analogy, it's like the S&P 500 has an S&P index committee, and SPY or VOO or any of the others just track that index that the committee manages. I'm the head of the investment committee. We manage the index discretionarily, and WTBN tracks our index. So how's it done? So if you go to the first chart, in blue on the first chart is the performance of the index. In orange is the performance of the Bloomberg US Aggregate Index, the broad-based investment grade index. I could have picked JP Morgan. I could have picked the ICE Domestic Master. Just because of familiarity, I picked the Bloomberg Index. And in the bottom, it shows the differential of the performance. Through the end of June into early July, our index has outperformed by 98 basis points, or almost 1 full percent over the Bloomberg US Aggregate Index. If we go to the next chart, this is the Morningstar breakdown of its performance relative to its peers. Now, Morningstar categorizes it in the intermediate core plus group of funds. Core plus means it could buy high yield. We could theoretically own high yield as an out of index bet. We haven't done it. We've only been around for 7 months, but we could. So we're in that category, and I think it's the appropriate category. Through year to date, our performance was up just slightly above zero, a little bit. And we are in the second quartile of performance of the roughly 642 funds. And in the second quarter, we were in the first quartile of roughly 645 funds that they have data for in the first quartile. So I guess 3 funds joined it in the second quartile as well. So relatively speaking, been very happy with the performance. Now, how did we get there? That's the next slide. This is kind of our tilt slide. So you'll notice that we are currently very neutral across the board, but we haven't always been that way. So let me start with duration. We were short duration from the beginning of the year when the 10-year yield was at 388, and we stayed short duration until the end of April when it was 468, and then we moved to neutral. The yield curve, we've been neutral all year. My bias is that the yield curve will steepen, but it really hasn't done much of anything. So we haven't put in a yield curve flattening or steepening position. That would be, how do you own your duration? Do you own it more bulleted or packed into the middle of the bond maturity range of bonds, or do you own it more dispersed or barbelled, kind of like at the 2-year and the 30-year sector? More bulleted would be a bet that the yield curve is going to steepen, that will outperform. More barbelled is it would flatten. It's been very flat this year. It hasn't really mattered what you've done. We've been neutral on that all year. Corporates, we've been 90% the weighting of our benchmark, so slightly underweight since February. That's been a slight drag on the index. Corporates have outperformed a bit, but not catastrophic. Securitization or structure, which would be mortgage-backed securities, started off the year very underweight, and we've been increasing, and we are now at neutral. And conviction is kind of the out of index bet. So earlier in the year, we had as much as 20% in short-term maturity or short-term duration or maturity tip securities. So 0 to 5 year tip securities. That was a very good trade for us, or it made us a lot of money. And for the last couple of months, we've been a 5% conviction weighting or out of our index long the US dollar. Now through forward contracts and the like, it actually has got a very high yield, a nearly 7% yield. So it's been a very good trade. The dollar has not only kind of crept higher, not a whole lot, but has crept higher while we've owned it, but it's got a big fat yield as well. So it was that short duration, and it was the securitization being short securitization earlier in the year, and then moving to neutral, the 0 to 5 year tips positioning, and then now recently the long dollar position. Combined, that's how we managed to outperform by almost 100 basis points in our index. And the tracker ETF that tracks us is in the first quartile, in the second for the just completed quarter, and in the second quartile for year-to-date performance. Now you'll notice we're pretty much neutral across the board. So yeah, we kind of look like an index fund right now, but we don't plan to be that way.
Jim, you keep mentioning neutral. What is neutral?
Yeah, so that's a good question. So let's go to the next chart. And I wanted to discuss a little bit about neutral. So this is a tweet from Mark Zandi, Chief Economist, Moody Analytics. Austin Goolsbee last week, who's the president of the Chicago Fed, said something very similar. I won't read it, but I'll summarize it. Inflation is coming down. And if the Fed doesn't cut rates, that means that real rates are going to continue to expand. And it's the effect, it has the same effect as tightening as if they were hiking interest rates. So the Fed has to cut interest rates. This is a narrative that's been around for many months, that various people have argued that with falling inflation and you holding rates steady and real rates expanding, that you're getting tighter and tighter and more restrictive on the economy. Now, technically that's true. All things being equal, that's true. But what it is implied in there is that the interest rate levels that we're at now, 5.25 to 5.5 on the funds rate, is some kind of a very restrictive level, and that it is punishing the economy in certain ways. I don't think that's the case. So let me step us through that. If we go to the next chart, this is the dot chart that the Fed puts out. This is my version of it. Each dot is one of the 19 members of the Fed. So they ask them, what's your forecast for where the funds rate will be at the end of the year, and then 24, 25 in the long term. And the orange line on the chart is the median. So if you look at the 24 dots, 4 members don't, and the gray band on the chart is where the funds rate is right now. So 4 members don't think they're going to cut rates for the rest of the year. 8 members think they're going to cut rates once. 9 members think they're going to cut rates twice this year. And so that's why the median is at 513, or 1 rate cut and then 4 rate cuts for 2025. That's what everybody focuses on. I think what we need to focus on is that long-term dot down at 275. Now, if we go to the next chart, the reason I think we need to focus on it, here I spliced together all the long-term dot charts back to 2019. So you can see where all the Fed members were, and then you can see where the medians were. And yeah, I can understand why we didn't talk about it, because it was stuck at 250 for years and years. It never moved. It was always the same number, so you could kind of ignore it. But the last 2 updates, the March update and the June update, the Fed updates this every other meeting or quarterly, it started to move higher. And Jay Powell addressed this at his presser last month, and he kind of said, it's a theoretical exercise, we're moving it up. I wouldn't read too much into this. So the Fed thinks that the neutral funds rate, what is neutral? That is the rate that neither stimulates nor restrains the economy. The neutral funds rate's around 2 3/4. Well, if you're at 5.25 to 5.5, and that's 275, almost 300 basis points above it. And inflation, you believe, is falling. Oh my God, we are way too tight, and we have got to start, thinking about, raising or cutting interest rates. Otherwise, we're going to choke the economy. That's what Zandy said. That's what Goolsbee said. And I don't want to pick on them, and they're just the latest to say it. That's why I'm picking on them. Lots of people have said that. Go to the next chart, however. There is a differing opinion. So the orange line is the same orange line. That's the Fed was at 2.5% for years, and then they bumped it up to 2.75. Now the green line and the blue line are market-based measures of what the market is pricing in for neutral. So the blue line is market-based neutral rate. This is, you're looking out at all of the Fed fund futures contracts out over the next 4 years, every day, looking out over the next 4 years. Where is the lowest point over the next 4 years? That's the blue plot. The green plot is the 5-year swap yield. Now, what is that? The swaps market, you could deconstruct the yield curve. I'm going to try and keep this explanation simple. And the 5-year is just telling you what is the 5-year yield in 5 years. So longer term, where do we think that the 5-year yield will be in 5 years? Another estimate of what neutral would be. And you can see that the green line and the blue line track each other pretty well. They should. And both of them are at around 370 or so, over about 100 basis points higher than the Fed's number. So the market thinks that the funds rate, or the neutral rate, is 100 basis points higher than the Fed. And where does that matter? If we go to the next chart, little complicated to understand, but hopefully I'll step you through it. So let's start with the green line on the bottom panel. That is the number of 25 basis point cuts, the market estimate of the neutral funds rate. So that blue line on the top panel is the same blue line on the previous chart. It's the market-based guess as to where the neutral rate is. That gray horizontal line on the top is where the funds rate currently is. And so the blue line just basically says, how many basis points does the market think it will take to get to neutral, and then divided by 25 basis points. So it's 6.6 rate cuts. The red line is the Fed's estimate divided by the market, or minus the market, divided by 25. It's 10 cuts. This is why the Fed keeps talking about, and a lot of people keep talking about, Fed's got to get going here. Let's keep cutting rates. Why? Because they think they got to do 10 or 11 25 basis point cuts to get back to neutral. So let's get going here. That's a lot of work. Well, the marketplace thinks it's more like 6.5, and 2 months ago it thought it was 4. So the market doesn't think that the Fed is nearly as tight as the Fed thinks that they're tight. This explains, I think, a couple of things. We talk about long and variable lags. Where are the long and variable lags in this market? Because we're not really seeing any real weakness. Yeah, we're seeing a broad slowing in the US economy. That's after a strong second half of 23. But maybe one of the reasons that you're not really seeing real pain in the US economy is because the current level of interest rates at 5.25, 5.5, while restrictive, take 6 cuts, 5 cuts, a couple of weeks ago, now 6, to get to neutral, it's not that punishing. 11 would be very punishing. 10.5 would be very punishing. It's not that punishing. So the economy and the stock market can handle this level of interest rates, which is why the stock market keeps making new highs and the economy keeps hanging in there. So if that is indeed the case, you then have to ask yourself, why the urgency? If you only, if there's 4 or 5 less cuts that you have to do to get to neutral, then you don't have to be as urgent to start rate cuts. Those that are demanding, like Mark Zandy, we got to get going now because they think they got to do 11 of them. And this is something that doesn't get discussed a lot. And there's another, and so the other question is why? Why does the market think that it needs far less rate cuts to get to neutral than the Fed? And if we go to the next chart basically shows you the real funds rate. Now, this is the Fed's measure. I use the core PCE. So you take the federal funds rate minus core PCE, or real or after inflation funds rate. And the line is broken down into basically 3 sections. The first blue section is from August of 1982, when the great secular bull market started, until June of 2009, the financial crisis. Then the red part is June of 2009 to the COVID, and then the blue part is post-COVID. So let me start with the post-COVID period, and I'll work backwards in the chart. Currently, the real funds rate is 2.93%. So a lot of people will look, the Mark Zandys of the world, go, this is punishing, this is punishing, this is too much on the real interest rate. They have to cut. And my argument is they're probably anchored to that 2009 to 2020 period, the red part of the chart. During that period, the average real funds rate was minus 1%, that the funds rate traded 1% lower than the inflation rate. Well, if it was minus 1 was the average, and the shaded area is minus 1 standard deviation, and we're way above that, then yeah, you could conclude that we're at punishingly high interest rates and we keep screaming at the Fed that they've got to cut. Now, the assumption built in there is we're going to return to a 2% inflation world and that everything is going to go back to the way it was pre-pandemic. But there's another alternative. Look at the period from 1982 to 2009. The average during that period for real funds rate was 2.55%, we're 2.93. Plus or minus 1 standard deviation was 440 to 69 basis points. In other words, the current level of 293 is slightly elevated the pre-2009 period. What was it about the pre-2009 period that was different? The fear was inflation was not at 2%, but a little bit higher. And there was a greater uncertainty about inflation. So you had a much higher real funds rate like you have now. The Fed refers to this as R star. You know, so how does the Fed get to 4% on the funds, on the neutral rate? They would assume that the neutral inflation rate is not 2%, it's 3 to 3.5%. And not that they add another 50 basis points of cushion or R star on top of that, but maybe more like 100 basis points on top of that, and that would get them to 4. Why is Jay Powell so loath to talk about that? Because he has promised the president and the American public at every press conference for the last 2 years, they will get the inflation rate to 2%. If they move that neutral funds rate up to 4, it's a bit of an admission that they are not going to get to their 2% rate. So let me conclude this section by saying there is a divergence about what neutral is. Is it the market-based rate near 4%? Is it the Fed's rate near under 3? That matters. Do we have 6 rate cuts or maybe 5 like we had a couple of weeks ago? Or is it 10.5? Well, if it's 10.5, Jay, get going with these rate cuts right now. If it's 5 or 6, you could sit it out and maybe see how things go in 25. And that's really what the question is, because the reason that, and I'll throw Mohammed El-Erian in there too, the reason they're saying the Fed's got to get cutting is because they got a lot of work to do to get to neutral. It could take them 1.5 years to get there if they have to do 11 rate cuts. So let's get started. But if it's actually only 5, it's not so much of an urgency to get there. So this discussion of neutral, is really kind of important when it comes to looking at the market.
Jim, when are you getting off neutral?
Right, so let's put this into the final prospectus here. Why are we neutral? Because we look at the neutral funds rate as being somewhere near where the market thinks it is. And right now, I don't see a lot of reasons for the market to do much of anything. And to some extent, that's what it's sort of done over the last month or so. Now, I don't expect that to be forever. I've used the metaphor that it's like the roller coaster at the highest point. You take the chain all the way up, and then the roller coaster kind of stops up there, and everything's still. And that's kind of where we are. But in this metaphor, there's a lot of different tracks that the roller coaster could take that will go in different directions at different thrill rides. And we're kind of waiting to see which set of tracks is the market going to take. Is the economy going to slow? And is the Fed going to start aggressively cutting rates? That's one set of tracks. And on that is the market going to reject that because it's going to say, no, you're going to create more inflation. I'm going to sell bonds and yields go up. Or yes, everything's falling apart, Jay. Let's get going with these rate cuts. So those are two sets of tracks it could go on. The other two sets of tracks it could go on is the economy is fine, inflation is sticky, and we got to stop talking about these rate cuts and maybe build in that we're just slightly above neutral. And if we don't get to restrictive, that rates might have to keep going higher. That's another higher rate story. Or the economy is fine and inflation is coming down and we could bring rates down. So two of those lead to higher rates. Two of those lead to lesser volatility. Two of them lead to more volatility or lower rates. So there's a lot of different scenarios. Now, if I had to guess, the set of tracks I would guess we're going to go to is the economy's fine, inflation is sticky, you've not raised rates enough, or rates are not high enough to punish the economy enough to rein in inflation, and we shouldn't be talking about rate cuts. That's what I think we're going to go, but I'm neutral because I'm not exactly sure we're going to jump on those tracks. So I'm kind of waiting to see what the next signal is. So in essence, our index is neutral. WTBN is effectively an index fund for now, as we try to wait and see what the next step is going to be. Now, I suspect we'll know by the end of the summer what that next step is going to be. We'll update you accordingly when we see it. And if you follow our research, it's kind of a running discussion about where we're going to go with that. The next big point on that will be the inflation report later this week. So that's where neutral, and why I wanted to drag in this neutral discussion, it really comes down to is, if the Fed starts cutting rates, where are they going? It might only be 4 or 5 or 6 rate cuts and they're done. And if the marketplace has got them doing 2 before December 31st, they're almost there, in 6 months. If they do 0, then they've got a little bit more work to do. But if the marketplace thinks that, no, they got to go under 3 and they've got a lot of work to do to get back to neutral, then that is a different scenario. So we are currently sitting at a neutral positioning relative to our index and relative to our benchmark in the index, to say it correctly. And we're kind of waiting for the next signal to see which way we want to go. And really, the next signal is going to tell us, what is that neutral rate? Is it near 4% or is it down under 3? And if it's near 4%, maybe a 2.5 or 3% real rate is actually normal now. It's not a negative 1% rate, which is normal now. And once these kind of come more in focus, we will reposition accordingly to try and take advantage of the situations that the market offer us.
Jim, thank you for your thoughts today, and thank you everyone for joining us. If you have any questions about today's podcast, you can contact us by emailing Gus Handler at gus.handler@arborresearch.com. Thanks everyone, have a great day.